Welcome to vTalkInsight, Allocator's Lens Daily for April 6th, 2026. Today's cross-asset picture is shaped by an unusual combination of upside growth surprises and an extreme energy shock. Strong U.S. data and lively capital markets point to ongoing momentum. Yet oil prices, shipping disruptions, and higher yields are forcing investors to reconsider how much risk they want to run. Let's start with what that means for equities. In equities, the dominant tension is resilient U.S. growth colliding with a sharp energy shock and higher yields. March payrolls delivered around 178,000 jobs versus a much lower consensus. Unemployment moved into the low 4% range, and strong retail sales and business surveys have pushed U.S. data surprises to their best levels in years. Corporate risk appetite mirrors that strength, with busy deal pipelines and prominent AI and industrial listings signaling that equity capital remains open. That backdrop helps explain why, despite recent volatility, headline indices are still trading not far from earlier highs rather than at recessionary levels. Price action, however, looks more cautious. Despite the strong jobs report, indices sold off, small caps lagged, and volatility remains elevated after a weak month for stocks followed by a fast rebound. Investors seem focused on whether higher for longer rates, combined with an oil shock, will squeeze margins and real incomes. Aggregate income growth was close to zero in March, and hours worked are soft, which clouds the outlook for discretionary spending even as headline employment stays firm. That disconnect between solid macro prints and more fragile income dynamics is increasingly important for equity risk premia. From an allocation lens, that leaves global equities in a late-cycle trade-off. On the supportive side, scenarios of robust U.S. growth, structural AI and industrial spending, and moderating wage gains underpin the earnings story and help explain why multiples have only partially derated. Offsetting this, the energy shock still appears underreflected in risk asset pricing. Demand destruction risks are building in Asia and Europe, and there's growing dissonance between equities near recent highs and bond markets, where many see better value after the rise in yields. Style leadership between quality, dividends, and cyclicals will be an important signal of how comfortable investors really are with this mix as we head into the next leg of the cycle. Turning to rates, the backdrop is a tug-of-war between firm data today and rising concern about growth and energy shocks later in the year. Treasury yields moved higher after the latest jobs release, with both the front end and the 10-year edging up, signaling a pushback against imminent rate cuts and some unease that the economy may be running hotter than previously thought. The oil shock is expected to lift headline inflation and keep core measures near 3% for several months, reinforcing the idea that inflation may prove sticky even without a wage spiral. Yet the Federal Reserve's tone is still cautious rather than aggressively hawkish. Wage growth has slowed toward the mid-3% range. Labor-driven inflation pressures look contained, and policymakers are seen favoring a wait-and-see stance while the war and volatile energy prices play out. Some scenarios still anticipate cuts later this year if oil-driven shocks tighten financial conditions enough, while others now push meaningful easing well into 2027 as persistent energy disruptions keep inflation elevated. That wide range of timelines underlines how uncertain the policy path has become. Positioning adds another layer. Surveys show a strong consensus that 10-year yields will move lower over time as growth risks build, even as larger fiscal deficits and potentially weaker foreign demand for treasuries argue for a higher term premium. That leaves the market exposed in both directions. If the economy and oil prices stay firm, yields may need to reprice higher. If growth rolls over sharply, there is room for a duration rally, but not from the ultra-low starting point of recent years. For multi-asset allocators, this also raises questions about bonds' ability to hedge equities when inflation scares have already driven positive stock-bond correlation at times. In credit, surface calm masks a gradual buildup of stress underneath. Investment-grade and high-yield spreads remain relatively tight, and have even seen some technical tightening as higher all-in yields draw in buyers. That demand looks more opportunistic than fundamentally driven, and it sits uneasily alongside slowing real income growth, expensive energy, and greater uncertainty about the growth outlook. The risk is that current spread levels underprice how quickly fundamentals could deteriorate if the macro backdrop worsens. Tension is sharper in riskier segments. High-yield and leveraged loan spreads are described as vulnerable to further widening if geopolitical tensions, oil shocks, and labor market volatility persist. In private credit, reports of redemption pressure, gating, and concern over older, cash flow-light vintages suggest that weaker capital structures are already struggling with higher rates. At the same time, fundamentals are splitting. Companies without solid earnings or coverage are finding refinancing difficult, while high-quality borrowers with strong balance sheets still look relatively resilient, creating a more binary distribution of outcomes. Energy is a key swing factor for default risk. Oil prices that stay well above levels implied by the curve would hurt margins for energy importers and squeeze consumer-facing sectors through gasoline and transport costs, potentially triggering outflows from credit funds as investors lean further toward cash and government bonds. If labor market slack increases in parallel, that would add pressure to both default expectations and recovery values, meaning tight headline spreads may understate underlying risk, especially in lower quality and less liquid areas. In foreign exchange, the dollar remains the quiet anchor of the current regime. Strong U.S. data, safe haven demand around the Middle East conflict, and relatively high yields keep the currency supported, even as periodic talk of a peak reemerges. That strength exerts pressure on energy importing economies, particularly in parts of Southeast Asia, where surging fuel costs already threaten growth and access to supply. A strong dollar and high oil together create a challenging imported inflation mix for these regions. The policy implications are awkward. Higher local currency energy prices and weaker exchange rates make it harder for central banks in Europe and emerging markets to balance inflation control against growth support. At the same time, global demand for U.S. treasuries may be structurally softer as many countries redirect resources toward domestic infrastructure and defense, limiting how far U.S. yields can fall even in classic risk-off episodes. For allocators, FX is the transmission channel of the energy shock. Moves in Asian currencies, the euro, and other importers' units will help signal where the growth burden of higher oil is landing and how quickly policy room is being exhausted. In commodities, and especially energy, markets are confronting an unusually severe physical shock rather than just a futures-driven move. Spot cargoes of Brent have surged above $140 a barrel, with some clearing north of $150 as tanker shortages and disrupted routes force buyers to bid aggressively. Refined products such as diesel and jet fuel in Asia are trading near $250, signaling outright scarcity for some importers and raising the risk of demand destruction, particularly in more fragile economies. The bottlenecks center on the Gulf. Escalating attacks on energy infrastructure, partial shutdowns in key producers, and new protocols and tolls around the Strait of Hormuz have cut shipping volumes and pushed freight costs up by $10 to $20 a barrel. Iran's increased control of transit routes, only partially degraded by recent strikes, keeps a large share of global supply at risk, and volumes through the Strait are not expected to return to pre-war levels this month. That helps explain why physical prices are so far above paper benchmarks, and why energy headlines are driving day-to-day swings in risk assets. Stockpiles are being drawn down to bridge the gap. Emergency reserves across developed economies are projected to fall sharply over the next quarter, potentially by around 1 billion barrels, which could force difficult choices on further releases if disruptions persist. The United States is trying to cushion the blow by releasing stocks, waiving shipping rules, and positioning itself as a supply backstop, while Europe plans for rationing-style measures and parts of Southeast Asia face severe GDP risks if they cannot obtain enough fuel. A key tension is that oil futures curves still point to a steep decline in prices over the next year, embedding an assumption that today's supply shock will prove temporary. If conflict de-escalates quickly and shipping normalizes, that may hold. If not, pricing may be underestimating both the duration of the shock and its knock-on effects on inflation, growth, and credit quality. For cross-asset allocators, the trajectory of Gulf infrastructure, tanker availability, and emergency stock draws will be central to whether the backdrop stays consistent with a soft landing or shifts toward a more stagflationary regime. Stepping back, we have seen that equities are caught between robust U.S. growth and an energy-driven squeeze on margins, while rates markets wrestle with whether bonds can still provide ballast if inflation settles near 3%. Credit spreads remain tight even as stress builds at the weaker and less liquid ends of the spectrum. The dollar continues to transmit the shock toward energy importers and commodities, especially oil and refined products, sit at the center of the global macro regime. For allocators, the common thread is that the distribution of outcomes has widened. The path of Gulf energy flows, the evolution of labor market resilience, and the timing of any Federal Reserve policy shift are likely to be key catalysts for the next phase of cross-asset repricing. Staying alert to how these forces interact across equities, rates, credit, FX, and commodities will be critical in the weeks ahead. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.